Assalamu alaikum, everyone. Thank you very much for logging in again to one of our many webinars that we've been having. This is, of course, our first webinar for 2023. Just as a matter of brief introduction, my name is Salahuddin Nasruddin, and I am the marketing manager. I work with Nadeem very closely to design and bring to you the message that we take to every community and to everyone in Canada, throughout Canada, and in all the areas that we are licensed, to ensure that you understand what we're doing and the benefits that we can bring to you. Let me see here. Okay, so I'll give Nadeem, of course, will be doing the meat and potatoes of today's subject. But since this is our first webinar, I thought, we do a little highlight of ShariaPortfolio Canada. And I'll just be showing you a few slides, and I'll explain a little bit about each slide. We, of course, are the sponsor of DSL. For those of you who know cricket, DSL is UAE's largest cricket league. So we are one of the premier sponsors of that league in Dubai. That sponsorship goes with our ShariaPortfolio global brand. As you're aware, ShariaPortfolio is Canada, United States, and global. So we are proud sponsors of this, and this league continues until March thereabout. We do a lot of masjid seminars, and we do a lot of masjid events. You could see Nadeem here with Sheikh Arij Anwar at the London Masjid. And of course, this is not the only time we had a seminar or event, but this is one I thought, and of course, if a lot of masjids do like to have these informational seminars that we put together with sheikhs as well as others. We've had, I think, Nadeem, many other scholars, Naveed Aziz, for example, we've had him on some of our seminars and events. So these are ongoing, and they continue every month, and more. Of course, last year we were hit, and the year before that we were hit heavily with COVID. Now that masjids are opening, these events are becoming a lot more possible. More so, the community is demanding these type of events where they can teach the Muslim community about finance and about investment and about the growth of their wealth itself. So yeah, here's another one, Masjid Seminar event. This is, I think, at the Khadija Center out in Mississauga. And here's two events that we participated last year in: the Muslim Medical Association of Canada and the Citizens Foundation. These are two large-scale Muslim nonprofits in Canada that we partner with at various levels, whether it's sponsorship or we participate. So these are the kind of things we do on an ongoing basis. Of course, many of these persons who attend these events are clients and are very interested in learning about our products and services. Let's see what's next. So this is the MAC annual convention. I believe this is MAC's first annual convention that was held at the Metro Toronto Convention Center. And ShariaPortfolio, of course, was there. This is our CEO and our client services manager in Canada, speaking to prospects and attendees at that convention. This is an event that we had in Quebec, one of the large masjids in Quebec, Montreal, which is in Quebec. We are licensed there now, so of course we do ongoing marketing and engagement with those communities. All of our material, of course, are in French for that part of the world. We do a lot of seminars, a lot of webinars, a lot of events, a lot of interaction, engagement with the community. These are just a few of them. This is, I randomly selected 9 and here they are. But we do this every every week, every month, throughout the year, with various communities, various scholars, CPAs, and so on. So a big part of our agenda in Canada, and for you, is of course education. I believe education can help a whole lot in moving the community and moving the knowledge of investing forward in a very fast way. Market Minute with Nadeem. This is a weekly annual review. Basically, Nadeem looks at the week before and the week that's coming up, and he gives a minute of his time, of his insight, of his expertise to you. And these videos, of course, are posted on our website. They're posted on our YouTube channel, and of course, they're emailed to everyone on our list. So this is an ongoing one, of course, and we find this very, very useful. We've had tremendous amount of positive comments on it because it gives a deep insight. This is not just what's happening in the market, but this is looking at the market from various angles, various perspectives, and Nadeem, of course, sharing his expertise on that. Let's see. Oh, and of course, bus ads in Mississauga. We've sponsored for the last 3 months bus ads, and it was Hello Halal marketing. Hello Halal investing marketing. It's marketing, of course, but halal investing. So this was ongoing, and this will continue for another 3 months in Canada. So if you're in Toronto, if you're in Mississauga, grab a picture and tag us when you add it on your Facebook or your Instagram, wherever. But these we have 20 buses, and these signs are on both sides, so you can spot them quite easily if you're walking around or you're driving around Mississauga. And this is a most recent event. We were at the RIS, and there is Brother Sajjad, who's our financial advisor from Vancouver. And there's Nadeem speaking to attendees at the RIS. But yeah, RIS is one of those events we believe, where Muslims meet and they make decisions on a variety of things, and one of them is investing, and we're glad to be there to share the information that we have to the attendees. For those of you who went to the RIS, congrats. It was an excellent event, I believe. Of course, Nadeem was there, and we heard some positive things. Let me see. Okay, and yeah, and this was a pretty big highlight for us also. In November, we our sister company SP Funds. SP Funds is the largest collection of Sharia compliant ETFs, and SPUS, SPRE, and SPSK. And on this occasion, we rang the bell, the New York Stock Exchange opening bell for SPSK. This is a pretty proud moment for the entire company, and we're glad to be there. We did ring the bell before for SPUS a few years back, but that was a virtual ringing. This is an in-person ringing. So yeah. We recently added a stock screening tool on our website. So for those of you who want to just check your stock out to see where it stands in terms of its Sharia compliance, you can go to our website, click on Stock Screener, and there you go. It's free. Most stock screening tools out there you have to pay for. This is free, and this follows the AOFI guidelines. So this is something I think it'll be useful for all of us on this webinar, as well as all Canadians can go on it. Of course, the stock screening is also on our app, on our Canadian app, and we did launch our Canadian and global app during last year. So so you can download the app, and there's lots of resources there on it. We'll be adding more and more resources that you need to manage your finance, manage your investment, and to make contact with us and so on. For those of you who have account with us, our app allows you to manage and to sort of review and follow your account. And a quick bit about ShariaPortfolio. Of course, we are licensed by the OSC, Ontario Securities Commission. We are licensed in Ontario, Alberta, British Columbia, and Quebec. ShariaPortfolio's parent company, which is ShariaPortfolio USA, was founded in 2003 in the USA, of course, and it's licensed by the the United States Securities Exchange Commission, SEC. We of course have clients across Canada, where we are licensed, of course, and that number is growing on a daily basis. We are the only dedicated Sharia-compliant portfolio management company in Canada. While there are many companies that may have Sharia-compliant portfolios, we're the only company that's dedicated to Sharia compliance. We partner with Fidelity, of course, a top-tier company. They are our custodian. And we provide two levels of service, an access and express service. The access is basically an actively managed account. It's great for comprehensive wealth management. And of course, our express service it's passive. And many of you who might have been speaking to Nadeem, you might have been discussing this. We also do special webinars on Express and Access, as well as on active and passive investing and the pros and the cons, and what works best at what time of the year and so on. Of course, we are insured up to $1 million by the Canadian Investor Protection Fund, the CIPF. And we're available online. You can call us, you can email us. We are on Instagram, on YouTube, Facebook, LinkedIn. And I know many of you have been communicating with us on these platforms, and we ask you to continue to do that. So with that, I want to hand it over to Nadeem, who will be dishing out the meat and potatoes for today, and of course, maybe for the rest of the year. So, Nadeem, over to you.
All right, Jazakallah khair. Assalamu alaikum, everyone. Thanks for joining us tonight. I'm just gonna share my screen here in a second. All right, everyone can see that? Right, we're good?
Now we can, yep.
Yeah, okay, perfect. All right, so before I begin, just some quick disclosure notes here. This session is for informational purposes only. It's not to be construed as financial advice or anything of that sort. We obviously recommend that you speak to your financial advisor or your investment professional on any recommendations or anything that's discussed on this during the session. So let me just get right into it. For those of you who are returning, welcome back. For those of the newcomers here, welcome. We hope this won't be your last webinar or an engagement with us. But tonight I will be discussing our actively managed portfolios. The slide that you see here is just the suite of portfolios that we have. Depending on what your profile is and what asset allocation you fit. So for the purpose of this webinar, we are going to be talking about this. And also, I encourage everybody to use the Q&A box at the bottom to put your questions. Put them down now. I will get to them at the end of the session. So it's an open platform. So let's get right into it. 2022, it's over. What happened? What were the major issues? This slide, I think, definitely symbolizes what happened. What do you mean the wind has changed? I think for a long period of time, we were living quite comfortably, and all of a sudden in 2022, the financial markets really got rattled up. So what were the main topics? Inflation, number one. After a whole generation without inflation really becoming a problem, inflation actually became a thing. don't fight the Fed. We saw unprecedented rate hikes, in 2022. Nothing like we've ever seen before, quite frankly. And I've been doing this for 25, almost 25 years. So, and of course, the rate hike did kind of signify the end of the easy money era, in my opinion. I will be diving into those two topics, on some later slides, because obviously that's been, I would say, the major headline for financial markets in 2022. We saw strength in the US dollar. We saw the crypto collapse. There was obviously a lot of volatility in the foreign FX markets in general, whether it's the British pound, Japanese yen, even the Canadian dollar. So that was obviously, something to watch out for. And bond markets, were definitely in the news, and I'll be talking about that more, in later slides. And last but not least, geopolitics. There wasn't a boring day, in 2022, leading, of course, with the events in Russia and Ukraine, and even China, with some of the issues that were going on there. So, first off, inflation. It is one of the elephants in the room as far as when it comes to this topic of investing. And what were the causes? And I broke it down into two. There's demand and supply. When it comes to the drivers, what we saw really was exodus from the cities, and that did result in a housing boom. Now, I am speaking mostly about what happened in the US, but to some degree it's also happening in Canada as well. But what we definitely did see a spike in home prices across North America and for the world, in the world rather. But we are starting to see that come down. So that's why I've used the green arrows here. The green arrows are actually what I would say positive trends, where previously in 2022 we saw this exodus from cities, but now we're starting to see real estate markets cool off. We're no longer seeing that exodus to the cities. We're no longer seeing lineups to buy homes like we've seen in maybe in 2021. Work from home, that's slowly not being that much of a thing more. And that also did cause a lot of demand, believe it or not, when you're at home and you wanted to kind of upgrade your home, and that led to a lot of spending that did create inflation. Revenge spending on goods. Again, we're kind of just spending money because, quite frankly, we're at home and we're upgrading and things of that sort. So that did lead to, again, those are demand factors that led to inflation and causing prices to go higher. Revenge on spending travel. Now, I didn't put a green arrow there because we still haven't seen a drop in that. So the previous thing, we started to see cooling off effects from these causes, but revenge spending on travel, people were just locked up and they were ready to go. And I think that's something that is definitely transitory. It's something that's short term, and it will probably cool off maybe in the next quarter or so. Fiscal stimulus, that's something that I would say is still there. We did see a spending bill in the US, about 1.7 trillion that got passed. We're not seeing fiscal tightening right now per se. So, and even in Canada, we're not seeing, fiscal tightening. So that's still there. That's why I didn't put a green arrow there. It's something that you could say can still, cause an increase in demand. And last but not least, low interest rates. That's probably the biggest thing, because it's kind of inverted. We're in an environment where rates were low, making money cheap. Actually, rates are now much higher. So this, again, is what I would say, with rates going higher, or I should say with low interest rates not being there, that's actually having what I would say a positive effect on inflation cooling down, right? And on the supply side, that's where I think a lot of the headlines were. We saw disrupted supply chains. That seems to be getting better. A bullwhip effect, and for what that means, the best example that I can give you is, when people were, for example, hoarding toilet paper. And what happened at that point was you saw this big spike in demand in toilet paper. It resulted in maybe toilet paper prices going higher. And that just creates a whole bunch of disruption. It causes prices to go up, and suppliers and retailers will jack up the price. and all of a sudden it's coming down. So now we're starting to see the opposite effect. We are starting to see prices come down on what was previously unusually high demand. Last but not least, well, not least, but Russia and Ukraine war. I think it's, although that war is still ongoing, I think it's become something that we've adjusted to, in the sense that when the war did start, we saw a huge spike up in price of oil and the price of wheat and some of these other commodities. We've actually seen a significant drop in those prices now. So again, that's something that we're seeing. Number one, maybe the world's adjusting to it. Number two, hopefully, inshallah, maybe we could see an end to this conflict. I know there's a ceasefire that's going to happen, I think this weekend, but maybe that's a better sign. Maybe that's a sign of things to come. Last but definitely not least, labor participation rate. Now, what this simply means is we have tight labor markets. The unemployment rate has not exactly gone up. And it's causing wage inflation. And of all the I guess bullet points here, this is probably the one right now that I think is probably the biggest cockroach now in the room for inflation. And wage inflation is a real thing. It does cause inflation, and what we're seeing is tight labor markets where that's creating essentially inflation. So that's just something that we need to watch out for. But in general, you could see that a lot of the trend to cooling inflation is definitely happening. Now, the second thing I wanted to kind of highlight also was central banks increasing rates, right? And I guess the focus here was in 2022. You could see that blue line that looks like a stair there. This is the U.S. Federal Reserve increasing rates, and again, they did it at a very unprecedented rate. But I've also included a chart of the bond market. Now, the reason why I included the bond market, of course, we don't invest in bonds at ShariaPortfolio, but it's something that we do keep an eye on because it can be bond and credit markets can tell you a little bit about what's going on in the economy. And what the bond market was really telling us, at least in the last part of 2021, was that the rates needed to go higher and the Federal Reserve was behind. And you could see with the first bottom arrow there, the bond market rates were taking off much earlier than the U.S. Federal Reserve rates are taking off. So in essence, you could say that they were behind, and bond markets were getting it right in the sense that they were predicting that, rates need to go higher. And so they started that run up higher. Subsequently, today, if you fast forward today, that gap has obviously narrowed. And it looks like the bond market is now telling you that we could possibly get a pause. Now, this is an ongoing debate. You can either, we hear a lot of commentary from the U.S. Federal Reserve. They talk about what their policy is, what they want to do, what they want to see. That's that. And then at the same time, you have the bond market, which is essentially kind of like a voting booth as far as where we see interest rates and credit markets. And the 2-year U.S. yield is the gap between that and the Fed fund rate has essentially gone very little now. And so they are aligned, and that simply means that the bond market is pretty much maybe calling the Fed's bluff, if you want to call it, that maybe they're done raising rates. Again, something to keep an eye on. But having said that, we're when we talk about rate hikes, we can look at history as a guide. And a lot of my clients have they go back and they're like, well, when has this happened before? And one of the times where we did see a war on inflation and rates going higher was basically in the early 80s, when Paul Volcker was the the Fed chairman. And at that time, they were battling inflation. They were going through a series of rate hikes and quantitative tightening. And basically what we saw at that time was a drop in the market. The market in 1981 and into 1982 was down about 27% from its peak to its trough. And that's similar to how we fared, really. Now, I guess the main thing to kind of keep in mind is that the market really bottomed before the Fed decided to change their policy. And, I'm of the opinion that the market always bottoms before the data does. And again, although history is not definitely, guaranteed future, but it sometimes can give us a guideline as far as, what that environment was and what happened. And what we can also see from here is that during this period of battling inflation and rate hikes, from basically in the early 80s, you could see that there were periods still of positive equity returns. So it's not highly unlikely or impossible that you can have a period where the central banks are fighting inflation, tightening monetary policy, and and not get positive equity returns. Again, it's been done previously. Can it be done again? We'll see. But I guess the point of the matter, the point of this slide is really trying to tell you that the market does kind of anticipate what's going forward. And right now, of course, the consensus is that we are kind of we might be entering into a recession, or we are in a recession. So we'll find out. Here's just a couple of quick slides here. Again, taking a look back here, there was nowhere really to hide. This is kind of a list of ETFs that give you a good proxy to a variety of equity markets, commodity classes, even fixed income. And really, as the title of the screen is, there was nowhere to hide. There were a few areas of the market where you could have had a positive return, but most of those were in commodities. So you had to pretty much be invested in oil and gas or agriculture commodity or something of that sort. But there really wasn't anywhere. And I guess the most ironic thing about this slide is that even fixed income ETFs, which traditionally will tend to hold their own and maybe even do well in a bad equity market, we're actually incurring double-digit losses. You could see that from the bottom right, that a lot of these ETFs are invested into treasuries, and of course, because of rate increases, bond ETFs got hit quite hard. Even the Sharia compliant ETFs that we use, you can see that for the year they did post negative returns. I guess if there's any silver lining here, it was that Sukuk, which is a fixed income ETF, held its own compared to some of the other ETFs that you see, some of the other fixed ETFs that you see out here. So that's, and here's just a quick breakdown as far as how the market kind of traded within the month. You could see that Monday was definitely not the day to be buying, or maybe it was a good day to buy, but it really no day was a good day to buy, as you can see, or no month rather, except for we did get a little bit of a push, in the last quarter, with October and November having positive months. And of course, December, the Santa Claus rally didn't come around, surprisingly. Now, I do like to look at historical, backtrack and see historical numbers, just again to get a feel for what can lie ahead, right? Again, it doesn't mean that what happened in the past is going to happen again, but I think it what do they say? History doesn't. It rhymes, but anyways, I'm not going to get that right now. So a lot of questions from clients are coming. Well, we've had a negative year. Are we going to get another negative one? So, if you take a look right now, going back 95 and 94 years on the S&P 500, you could see that we've had about 31 down years. So again, overall markets have been, having positive returns, but almost a third of the time we've got negative, years, calendar years. Now, when it comes to consecutive negatives, we've only had 4 consecutive negative years. In other words, back to back or back to back to back. And highlighting those 4, you'll see that number 1, first was the 1929 to 32 is a Great Depression. Obviously a major event. Subsequently in 39 to 41, World War II. Again, another major event. 1973 to 74, we had the OPEC oil embargo plus inflation. And so that was kind of obviously, I would say an economic situation, of course. And the last time we had a back-to-back, negative year was basically 2000 to 2002. That's actually when it kind of started in the business. And that was the tech bubble. That was an asset class that just decided to burst, and people were heavily invested into that. And of course, you can add 9/11 into that as well. But point of the matter of this is that I think out of all of these events, really, it shows that you need to really have a major event for markets to at least experience two negative calendar years. At least historically, that's been the case. Some can argue that the oil embargo in 1973, 74, there weren't really any major, it wasn't like a depression or a war or an asset class crisis or anything of that sort. But overall, I would say that it would have to be an epic kind of black swan event for us to now, at least historically, get a back-to-back negative year. Again, anything can happen. For those of you who attended last year at this time, we gave a webinar again in January of 2022. What did we say at that time? At that time, I did call for a first half volatility, which is what we got. The economics still remains strong, and that actually still is true. The U.S. economy especially has been pretty resilient in the face of rate hikes. We felt that there was going to be tactical opportunities, and one of the calls they did make was that the bulk of the market gain was going to be in the second half. I guess you could say I was a little late. I was a little early on that. I think we really started to we hit the low in October, and now we're starting to kind of bounce off there a little bit. Just quickly, we were overweight energy, healthcare, large cap tech, and materials. I would say the first two we got right. Large cap tech, no, unfortunately we did not. Materials has been a little bit of a wash in the sense that we saw a good run up in some of the energy and material stocks. We also saw some pullbacks, but we also received quite a few dividends from some of our holdings. So at the end of the day, it's actually paid decently for us. And of course, we believe that active management would outperform passive. And that brings us to this slide, which is what our model portfolios did for the year. This is the actively portion, the actively managed models. And overall, again, negative returns aren't always something to brag about. But I would say, we are all playing in the same sandbox here when it comes to investing. And relatively speaking, we think we did okay. We actually outperformed a lot of the benchmark and our peers. So this was in football terms. If anybody watches football, I like to say this is that we gave up field goals, but we didn't give up touchdowns, right? And at the end of the half, right, we are down, but we're definitely not out of the game. I think what puts people out of the game or can make it hard for them to come back is when you do get that big, drawdown of 35-40% in your portfolio. And that can be, a situation where it's going to take a much longer time to get back. So in our case, what we did was, and what helped our performance here was, as I mentioned before, we were overweight energy, just to kind of in our portfolios. That did help. EOG, HP, Coterra, those were some of the names that we owned in our portfolio. Energy was one of those trades where we got in at the start of the year. We did lighten up our position, towards the middle. And as of late, we started to kind of get back into energy, with oil coming down back into the 70s. We were overweight healthcare, which again was a decent call. Merck has been a great holding for us. Pfizer as well, not so much. I mean, again, a lot of these, both of those names do pay a dividend, which is good. Pfizer has been, relative to the market, it's done okay. And a newer name in the portfolio has been Intuitive Surgical. That's a medical equipment maker. And that also, especially in the second half of this year, has done well for us. We are now currently overweight emerging markets. I know I put China and Latin America, but I'll just use the term emerging markets. And I would say, that's been a call that has definitely benefited us right now. Some of the names that we own: JD, Pinduoduo, Vale, which is a Brazilian mining company. And China is. I'm going to talk more about China in a bit, but the Chinese economy, this Chinese market has been underperforming for much longer than just the last couple of years. It's had its issues with a lot of things, and a lot of the stocks have been beaten down. But we do think that things are kind of trending in the right direction in China, and for some of the stocks there. Last but not least, U.S. cash. I like to say cash is also an investment strategy, believe it or not. And especially in our case, we did use U.S. cash, for a lot of our portfolios. And the reason why I say it's an investment strategy is because a lot of the times when we are presenting to new clients, we have to kind of convince them that, hey, take your Canadian dollars and move them to US. And they're like, well, no, the rate's 130. Why am I going to do that now? I'm going to lose money. No. And so, it has been definitely a positive for us. Now, having said that, like I said, we're playing in the same sandbox. So we obviously did get, although all this sounds good, we were invested obviously into technology and some of the other sectors that did get hit. But overall, I would say, for the year, if you told somebody I'm down 10, 15%, with all that, it's actually quite a win. Like I said, we're giving up field goals and not touchdowns. Now, before I get into this, I had this on my last webinar, and because I got tired of those Quest Trade commercials, right? Where they make fun of people, using advisors, and they're saying how cheap it is to trade stocks and all that other stuff. Because what we had in the last, let's call it from 2010 to that decade, those 10 years, was passive investment. It was about cheap fees, no trading fees, buy me an ETF, and you know what, I'm going to do better than everybody else. And that was the name of the game. We had zero interest rates, and markets were in a risk-on environment. So that was the game. And we saw passive investing outperform active, no doubt. But I think we're in a different environment. And the reason why I say that is because if you take a look at the decade before, active actually outperformed passive. And again, we were in this era, rates were somewhat of a thing, not as much as they are now. But, you had interest rates, you had some other, economic issues. And I think that's when active really, kind of earned its buck, so to speak. So, going forward, we're of the opinion that the free money era is not there anymore. And so we might get more of a period like this, where you actually have to do homework and, rather than just going out and buying the most cheapest ETF out there. Now, getting into today's time, right? We've seen a drop in valuations. I'm going to kind of dive into, some of the stocks and what's going on out there. And because people ask, okay, where are we? Is the market cheap? Is it not? This is just one metric. Now, one metric doesn't form a whole thesis or an opinion, but it is definitely something to keep an eye on. And what this is basically telling us is these are the forward PE ratios for the three S&P indexes: the S&P 500, the S&P 400, and the S&P 600. 500 is a large cap, 400 is a mid cap, 600 is a small cap. And essentially what this is telling us is that the small and mid cap stocks are actually trading near their 2009 valuations. Small caps and mid caps are trading at 13 times, as the small caps are at about 12. So the argument should be, well, have they factored in the price of a recession? Has the bad news already been priced in? There's a strong argument for that. And now when it comes to the large cap, which a lot of people, of course, and even myself, we follow the S&P 500, it's also dropped in valuation, but you can see that there's still, it's still trading, at a premium relative to the other, the small and the mid cap. And, a more deeper analysis actually is this. So the S&P 500, it is market weighted, meaning to say Apple is the largest component. It's a $2 trillion company. So its weighting is going to have more on the S&P 500. Now, there's also something called the equal weight S&P 500, which means that Apple has an equal weighting versus the rest of the 500 companies. And when you take that index, you'll notice that the multiple comes down quite a bit. So the point of this point is that the big names like the Apples, the Googles, and the Teslas that are making up, most of the S&P 500, those are still trading at a pretty premium valuation relative to some of the other stocks out there. So I think at the end of the day, we think that there are opportunities beyond the usual suspects. And what I mean by usual suspect is that, the big large cap names that we typically, well, Apple, Microsoft, and Google. Again, not to say that they are bad companies or that they shouldn't be bought, but it just simply means that, if we're looking to outperform, if we're looking for opportunities, they might be presented more in other names, right? Sentiment sucks. I like to take a look at sentiment indicators because this is a great contrarian indicator. It tells you, there's a joke that, back in the old Wall Street days, they would tell you if the shoe shine boy is asking you for stock tip, that's when you should get out, because that's when things are going too good in one direction that even the shoe shine boy is asking you that. It's the other way around as well. If people sentiments are so, pessimistic towards the stock market, they don't want to talk about it, they don't want to be invested in it. It's the polar opposite of exuberance. And so, right now, the AAI bullish sentiment indicator, that's really kind of telling you that we're at number one, we're at 20, and average, the long-term average has more along been around 40, maybe 50%. And, historically, anytime that sentiment indicator has dropped, it has been proven to be a pretty good time to get into the market. Likewise, the chart on the right, that's basically a Bank of America a survey, which basically is talking about fund managers and what their positioning is. And you can see that, again, when their expectations for a strong economy are actually down, that typically has been, great times to get into the market. The light blue line signal, is the S&P 500, and the dark blue line is kind of their sentiment, right? So again, the point of the whole matter really is, sometimes it does pay to be a contrarian, and some of the indicators out there are definitely telling us that. So now looking ahead, right? What's my outlook going forward? I'll first kind of speak macro, and I'll start off by saying I am cautiously bullish, going forward. Inflation is falling faster than expectations. That these are some of the latest readings, especially when it pertains to the U.S. And we're seeing that really. I mean, we've seen gasoline prices, freight prices, we've seen wheat prices, a lot of those commodities and stuff like that have really pulled back quite a bit. So we are seeing positive trends, obviously, in that direction. The Fed is likely to halt its hawkishness in 2023, and this would confirm what the bond market is telling you, and this will also kind of be in line with inflation tracking lower than expectation, right? That's the main thing, is that if inflation continues to track below the Federal Reserve's expectation, I think that's going to be a positive thing for markets. The U.S. economy has been resilient in the face of these Fed rate hikes. I mean, it's a good thing and a bad thing. In some cases, the U.S. Federal Reserve wants to see the labor markets loosen up a little bit. They don't want it too tight, but so far, that hasn't been the case. Europe and Canada not as resilient. We have different economies, and Europe obviously has its own situations there as well. The debate now really is, are we going to go into a recession, versus are we going to have a soft landing? Soft landing is just another fancy word for saying slow or no growth. And when it comes to equities, it goes back to my point. Are equities already pricing in a recession? The consensus right now is that we're going to be in a recession, right? And consensus doesn't mean you're wrong. It just simply means that is the consensus already priced into the market? And the question now becomes, do we, what's the headline 6 to 12 months from now? And if the 6 to 12 month headline is trending in the right direction, the market's going to try to get ahead of that. And that's what that chart that I showed with the Volcker, that's what I was trying to prove, really. Back-to-back negative years are rare, having occurred during extreme events. I spoke about that. China reopening, I haven't talked too much about that, but yes, China is reopening finally. They've obviously had that zero lockdown, and I know they currently have some COVID issues right now, but it's like that genie in a bottle. Once it's out, it's out. I don't, it's going to be hard pressed for them to now go back. Similar to what happened in North America when we started to open up, it kind of became a situation where we weren't going to go back to that lockdown. Hopefully, inshallah, we don't. But nonetheless, it is the second largest economy in the world. It is a major driver in global landscape. And so with China opening up, this can obviously be a pretty big thing. Similarly, supply chains are easing, and that's part of China and some of the supply issues, them being the provider of a lot of the goods and materials that they export to the world. If that eases, that's obviously going to help bring down inflation. Lower PMI, that's the producer manufacturing index. That's the manufacturer's inflation number, CPI. Again, if manufacturers their costs are coming down, then that should translate into lower inflation for even consumers. And of course, cooling off of the US dollar. Now, I'm not one to call a collapse of the US dollar, but 2022 was a phenomenal year for the US dollar. I don't expect that to happen again, but when you get some pause or cooling off in the US dollar, that's actually a positive for a lot of companies and countries. For example, if you have technology companies that get half of their sales, say, outside the US, and they can, when they're bringing their money back, they can actually when they're doing business, it actually does help when the dollar is weaker. And last but not least, so these are obviously tailwinds that can obviously help corporate earnings. And I think we're also aware of some of the headwinds as well. Like, for example, global slowing of the economy, consumer spending could slow down. That's obviously a potential thing that may actually happen, but we think that some of that can be offset by these tailwinds that are there. Of course, we're not going to keep our blinders on. We want to try to cover our blind spots here. Of course, there are risks, geopolitical. That's always a tricky one to predict. Whether it's Ukraine, Russia, China, Taiwan, these are obviously there. Fed continues its hawkish policy. The Fed is obviously talking a pretty hawkish game. The bond market is calling its bluff. I think at the end of the day, what's going to matter is all the prescription that the Federal Reserve has been doing with this rate increase. They want to see the effects of them kind of play out, right? So I think as time goes on, if we start to see some of their rate hikes, having its effect, I think that can obviously, hopefully that happens. But if it doesn't, or they just continue, they overshoot, that obviously can be a negative for the markets. And last but not least, of course, an economic recession, right? That's obvious. That's somewhat tough to call, but if we do enter in a recession, is it mild? Is it harsh? How long can it last? That's all stuff that can obviously be a potential risk. But the probability of the risks, we're not putting a huge number on that. Let's just say that. Now, when it comes down to equities, as I mentioned before, we're favoring passive over active. This chart over here, basically, I presented this in my last quarter webinar. This just tells you, what previously when the S&P 500 has been down 25%, what has been the return again in the next 1, 3, 5, 10 years. And you can definitely see that, the odds are, that are somewhat in the favor of having a bounce back. So bear markets have been usually followed up by prolonged, strong bull markets. We have strong demographic cycles in play. That still seems to be the case. And what I mean by that is there is this wealth transfer of boomers to millennials. This aging population that has the massive wealth is eventually, it's going to get transferred over to the millennials. And millennials are, for what it's worth, they're just they're the age group between, call it 27 to say 39, and those are the highest consuming years. So consumption obviously is a big driver to markets and the economy. So, and historically, anytime we've seen that age group increase in population, that's actually been that's been also followed up by an economic boom. And last but not least, I guess the game has changed. I think the era of zero interest rates, low inflation, risk on environment, I think we're done with that for a while. And that's why I think valuations will finally start to matter. And that's why I think, the Questrade commercials are going to be, not that funny anymore. So what we do in our investment strategy is we operate what's called a core satellite strategy, investment strategy. And we do still use ETFs to get access to, various asset classes efficiently. So we do that, for example, with Sukuk and even the REITs. But that's the core position. And where the active part is where we are actively stock picking to get that alpha and to manage the risk, of course. And we are definitely in an environment where I think smart growth will, trump silly growth. So that again means that, we are, definitely going to have to go old school here and do our homework. Sharia compliant investing, we expect that to outperform traditional. And the reason I think one of the easiest things to say is that the cost of debt is obviously increased, and it might come down, but we don't think it's going to come down that much. And if fundamentally, one of the main reasons why stocks don't meet our criteria, the Sharia criteria, is because they can't meet the debt to capital ratio. And fundamentally, we are buying under leveraged company, that means. And so in that case, I think, as long as we're doing that in the environment that we're in, I think that should help us. We use a top-down, bottoms-up approach. We what that simply means is that we do look at the macro environment and some of the trends that are going out there, and then we do follow that up with a bottoms-up approach, meaning we do look at that point security selection, individual stocks, how what they're doing as a business. Now, in some markets, top-down analysis actually is much better to do than bottoms up, and vice versa. Right now, we're probably in a minute where top down is much more important than bottom up. It doesn't matter if you have the greatest company in the world. If it's like saying I got the best house in a bad neighborhood, right? So that's kind of our approach. We do use fundamentals along with technicals to make our investment decisions when it comes to security selection as well. Now, kind of diving into equity strategy specifically, what are we looking at this year? We are overweight healthcare, infotech, technology, energy. So we're still kind of continuing that theme, and some commodities. And last but not least, emerging markets. And I think that's probably where I'm most excited about. So emerging markets is definitely, and I guess it goes to my point why you should now be an active investor, in the sense that emerging markets is definitely something that an active approach can benefit from. Some sectors that we're a little bit leery on, or maybe cautious or underweight, are consumer discretionary and communication services. Again, if we're in a recessionary environment, or even if it's a slow growth environment, consumer discretionary stocks might have more of a trouble in that environment than other sectors. So specifically healthcare, just some quick bullet points. I call it the defensive. It can be a defensive growth play, where you're playing defense, but at the same time, even if you're in a slow growth or recessionary environment, these companies can still grow their earnings. And that's been kind of proven in the past. Long-term demographics are definitely in play. We definitely have an aging population. The demand for healthcare is only going to increase. Also, with the pandemic, we've seen a more of an awareness in healthcare, number one. And number two, we've also seen somewhat of a renaissance in healthcare, meaning some of the technology that's being developed in the healthcare industry, they're going through a renaissance or phase where they're developing more drugs, more technology, and things of that sort. So quite interesting, that sector. And last but not least, the medtech, biotech. They offer a combination of healthcare and technology. So if interest rates, for example, start going down and you're in one of those companies that is in healthcare but has technology, you can not only, capitalize on the earnings growth, but you might even capitalize on the premium by rates going down. Infotech, technology, secular, the strong secular long-term trends are still there, meaning to say that, the spending in technology is not going to stop. In fact, with some of the wage inflation that we're getting out there, technology might actually benefit. So in other words, if there's a tightness in labor, you can't find workers, you might at that point, companies might decide to spend more on technology. And that can also reduce, cost. Soft landing, if the economy doesn't go into recession and we get a soft landing, you could definitely see, some companies raising estimates. Weaker US dollar, again, that's definitely a positive for a lot of companies that are making money abroad. Flat and falling interest rates. See, in this point, the flat falling interest rate, that's probably the biggest thing that's hurt technology is interest rates rising. I guess the example that I'll give you in this, again, everything is my opinion here, like Tesla, which was a very expensive stock on a multiple basis, got destroyed this year. And yeah, sure, you can blame some of that on Elon Musk and Twitter and all that other stuff, but really, interest rates pounded this stock, down. And it's all based on valuation, rate hikes going. The valuation of Tesla is based on future earnings. And if your interest rate is high, guess what? Those future dollars aren't worth as much anymore as they used to be. And that's what essentially I would say is the major part, what really hurt Tesla's valuation, aside from the circus that also has been going on. Outperformance will not come from the usual suspects. In other words, not the mega caps. I think there's going to be a lot of interesting opportunities in technology, although, some of the big names might still be a good opportunity to get in. I think the outperformance is definitely going to happen in other areas. Energy, I'm a big fan of energy. It was my biggest, I guess, winner last year. I continue to be a bull on this. Right now, the focus is on energy security. That's going to warrant a higher valuation. Recent elections in the U.S., Democrats have pretty much kind of held DC, and that means that they're not oil friendly, which means they're, at least in the US, they're higher oil prices. So, you can expect, oil companies to get higher EPS upside. Structural issues remain. And what I mean by that is for many, many years, there hasn't been any reinvestment going back into the oil services. So there hasn't been this, new supply out there or this investment where we're getting new oil from other markets and other, countries. That hasn't been the case, and so because of that, it's causing the supply issue, and that's not going to just change overnight either. It still is a small component of the S&P 500, and I think that just simply means that it is underinvested. Not a lot of institutions own it, especially with the ESG movement. A lot of institutions kind of got out of oil, but and that has caused its valuation to come down, but at the same time, it's made it cheap. They're very profitable even with oil at $70. And we're starting to see that a lot of the oil companies, they've given out dividends, strong buybacks. From a shareholder perspective, that's great return. Of course, there's the geopolitical issues that are out there. And even inflation, I mean, it's going to linger. These are all reasons why you might want to own gold because it can be a hedge for that. Last but not least, emerging markets. Again, I think with China, it was the first to fall, and it's going to be maybe the first one to get out of this mess. So with it reopening, they didn't have that revenge spending, that revenge travel that we had in North America. And hopefully we might start to see that. And if we do see that, then you can start to see Chinese, spending, coming back. And some of the inflationary pressures that are in emerging markets, like in Asia, they're less. And especially, with a lot of these countries buying commodity prices have actually come down. They don't have, and their central banks are actually also, a lot of them are doing normalized monetary policy, like in China. they're not tightening rates. They're actually trying to stimulate growth. So they're on a totally different wavelength than what we're doing here, which is the exact opposite. We're trying to tighten. And, they don't have that labor shortage problem that we do. And again, that's been, I think, one of the risks in this market is that, that's what's keeping inflation where it's at, is this wage inflation. So, having that as not a problem, that's a good thing. And there are just some strong long-term trends in place. Latin America is quite interesting. It potentially could have the highest growth in e-commerce anywhere in the world. The US dollar can be a tailwind as well. With US dollar kind of cheapening up, it helps emerging markets as well. And last but not least, Sukuk. I'll say a couple of words on this. Sukuk is, for those of you who don't know, it is classified as a fixed income. These are Sharia compliant fixed income certificates. Most of the Sukuks out there are issued by emerging countries, Muslim countries like Saudi and the Gulf and Malaysia, Indonesia. And I think, what we're seeing now is with rate hikes at pause or maybe even dropping, we could get hopefully some appreciation in fixed income in general. That's how they work. Rates go down, prices of bonds go up. Same thing, Sukuk operates to that same beat. And of course, the second point is that, fundamentally, a lot of these countries are in much better financial condition than a lot of other countries. So there could be a possible that there could be a credit rating upgrade, and that always kind of helps prices of Sukuks there on the market. So with that, I think that's it. I'm gonna stop here and start entertaining questions that you guys have. So maybe we'll just dive right in. Okay. Can you please, I want to hear from Nadeem Ibrahim here. Can you please shed some light on the Canadian real estate in reference of high inflation and mortgage rates? Okay, so yeah, that's a good question. Because again, we're all Canadians and a lot of Canadians do own homes. And that's why I said that the Europe and Canadian market economy hasn't been as resilient, because, like, first of all, when you take a look at the US, they have these 30-year fixed rate rates where you could lock in rates for 30 years. In Canada, that everything resets at 5 years, for most people, I guess. And, so if you're in the US, rates are going high, but you got a 30-year term, guess what? Okay, that's okay. It's not going to hurt you. I think in Canada, it will definitely hurt Canadians a whole lot more. Also, real estate is a bigger portion of the Canadian economy than it is for other markets. I am quite cautious on the Canadian real estate market. It is definitely, creating, it's creating a crunch for a lot of Canadians out there who own homes. But, specifically from a real estate standpoint, I was at a networking event the other day, and they were talking about, I was surrounded by a few real estate agents, and they were talking about how, supply and this condo in downtown Toronto was at this price, and it was at 750, it went down to 500. It's a buy, you got to buy. That's all good. The problem here, or the word of caution that I have, is everyone's looking at prices dropping. My next concern is, what happens if unemployment starts to go higher? Then doesn't matter how cheap that home is, doesn't matter how, what your rate is, you don't have a job to pay for it, right? I think that's the risk for the Canadian housing market now. Because here's the thing, when rates go up and down, we feel that immediately. In capital markets, you feel it immediately. Bond markets, equity markets, you feel that. When you do it in real life, when it comes to homes and people, those rate hikes are going to take some time to hit your pocketbook. And that's the issue, and not just the pocketbook, but even like the economy in terms of the job market. So I think that's where I'm a little bit cautious on the Canadian market. I would kind of be scared of that. But from inflation, though, inflation is coming down, and housing is contributing to that, right? Are we heading to a recession or disinflation? Do you have any comments on the proposed 2023 tax changes? Okay, well, I don't have any comments on the proposed 2023 tax changes yet. I can definitely, get back to you on that. But are we heading into recession or disinflation? It does also depend on, I guess, maybe, which economy we're talking about. In Canada, I do think we're probably going to hit a recession. That seems to be the consensus, and I think it is trending that way. In the US, consensus is a recession, but I think there's a possibility of getting a soft landing there. So and they've done, obviously they've done a pretty good job. So has Canada for some, but my sense is that I would say that in the US, although consensus is a recession, we could probably get a soft landing. In Canada, I do think we're going to get a recession, but I do think that the recession will be mild, and it won't be a deep one either. So if there's any silver lining, that's those are my thoughts. And the last thing I'll say is that if energy markets on the Canadian recession, if energy markets are doing well, that does help Canada in the sense that we are a net exporter of energy, and a fair amount of our business, our economy is in commodity space. All right, so for someone who has about 5,000 to 6,000 to invest, ShariaPortfolio only invest in a few ETFs along with Sukuk and real estate. Is it really worth it to invest with ShariaPortfolio? Because if it's mostly investing in ETFs for that budget, a person can do it themselves at beginning stage. I am finding it tough to find great value in investing with your company. Okay, well, so I mean, so the brother or the sister here is basically saying that if they have a small amount, does it make sense to invest with us? We're long-term. I would say we're a long-term investor, but at the same time, we're in the long-term business of building relationships, right? So even today, for example, right, if you become a client of ours, that doesn't necessarily mean that we're one and done. We're not a product company, we're a service company, and we'd like to think that as you grow in your life, as your wealth grows and your family expands and all that other stuff, we think that we could probably grow with you. And so we'd like to think that that's something that we can build together. Now, the other thing is, when it comes to some of these questions, we do provide financial advice even, right? It could be something as simple as, should I put money in a TFSA or an RSP, right? Should I do this? Should I do that? Like, these are all stuff that, even small investors will come to us with. And a lot of small investors don't even know, won't be aware, and even large investors aren't aware of, smaller things such as the RESP and what that is, and, and so forth. So, those are just some of the areas where we think we could add value. I think the last thing I'll say is that, look, we are Muslim owned, we are Muslim operated, and of course we are a for-profit company, but at the same time we like to think that we're also doing something for the community. And maybe some clients do appreciate that and may see the value in that, and we hope you do as well. Okay, got one here. How should one balance investing budget between ETFs and normal stocks? Is it recommended to buy strong dividends versus non-dividend? Well, so, I mean, how should one balance between budgeting between ETFs and normal stock? Again, that's stuff that we do as portfolio managers and as advisors. As I mentioned, we have that core satellite strategy where we put a decent out. So to give you an example, right, in some of our models, we might have, for example, a 10 or 15% allocation to Sukuk. We might have, a 5% allocation to the SPRE, and we'll probably have maybe like a 15% allocation to even the SPUS. Now, these tend to be core holdings. We're not really trading in and out of them. We might trim them sometimes to rebalance the portfolio, but in general, those are core holdings. So in most cases, in our actively managed portfolios, most of the holdings are out of our individual stocks. I would say at least 2/3 to 70% of it is. And then subsequently, you know, we would manage that portion. Now, the other part where you asked about is it recommended to buy strong dividend versus non-dividend? Well, that all depends, right? For example, in our moderate portfolios and income portfolios, we do tend to have a dividend focus on those portfolios. In fact, every single equity that we own in our income, I know, pays a dividend. Whereas in our aggressive and our growth models, dividend is not necessarily a requirement. Now, in some environments, it might pay to have dividend stocks. In fact, this year, if you were in dividend names, that did help the return because markets were choppy and, you know, the growth wasn't there, but dividends helped kind of cushion that blow, right? So it does, I think at the end of the day, right, it always helps to have a balance of both, but it also depends on, you know, which model you're in and what you're looking for. And so with that, were there any other questions, or maybe Saladin, do you have anything to add or any questions that you have on your end?
No, I think you were pretty thorough, and I think the few questions that came up, you know, had to do so much with a lot more with our product rather than, you know, the presentation you made. But it was good, alhamdulillah. I think there's any, there's no other questions. I guess we can call it a night. It was this video, of course, will be circulated to everyone on this call, on this webinar, and you know, you can look at it at your time. You can definitely share it, and so on.
Yeah, the last thing I'll say that if you if you're new and you are looking to become a client or would like to set up a consultation call with myself, you can definitely go on to, you can definitely contact me with the information there, or you can even go onto our website and go and click onto the Get Started tab and just put your information down, and one of our team members will be in touch, inshallah.
Yeah.
All right. All right. Well, Jazakallah khair. Thank you again, everyone, for joining us, and you know, look forward to doing this again soon, inshallah.
All right, great. Well, thank you very much, Nadeem, and thanks everyone for showing up tonight. Assalamu alaikum wa rahmatullah.